Welcome to the Risk Wheelhouse, the podcast where we navigate the ever-changing seas of risk management and technology. Join your hosts, Ori Wellington and Sam Jones, as they steer you through the latest trends, insights, and strategies shaping the future of integrated risk management. Ready to chart a course towards success? Hop aboard and let's set sail into today's deep dive.
Imagine you're sitting at your desk right now,
Right.
and you're staring at a vendor pricing sheet.
Oh, yeah. The dreaded pricing sheet.
Right. And you're about to cut $1 million check for this brand new enterprise software platform.
Yeah.
But then imagine finding out, like a week later, that you just bought the digital equivalent of an old 1980s filing cabinet.
And the vendor is just laughing all the way to the bank.
Exactly. And the crazy thing is, that is exactly what's happening in the governance, risk, and compliance market today. I mean, the GRC market is wild right now.
Oh, it really is.
So we're tearing down this illusion of enterprise software today. If you are a buyer evaluating vendors, this deep dive is built specifically for you. Welcome to this deep dive for the Risk Wheelhouse. This is produced by Wheelhouse Advisors. And if you want to explore more about integrated risk management, you can find everything over at www.wheelhouseadvisors.com.
Highly recommend checking it out.
So today, our mission is to give you a practical, no-nonsense guide for evaluating new GRC software vendors. And this is based entirely on our newly published article, Why Anyone Can Build a GRC Platform Now.
It is a provocative title, I know,
Yeah.
but we aren't exaggerating. The landscape of what you as a buyer are looking at right now, it has fundamentally shifted under your feet.
Yeah.
The ground rules from even just like 3 years ago are completely obsolete.
Okay, let's unpack this, because to really grasp what is happening, we have to start with the paradox of the 2026 market.
Right.
If you look at the funding tape, like the sheer amount of venture capital flowing into GRC, it reads like an entire massive industry is being rebuilt from absolute scratch.
And it is. I mean, it literally is.
Right. Look at the headlines. We have compliance closing at $20 million Series A, and their entire pitch isn't just, hey, we have a better dashboard. Their pitch to the market is that they are natively built on AI from the ground up, not just, layering AI on top of legacy code.
Which is a crucial distinction that we're going to tear apart today. The difference between AI native and AI bolted on, that's the central battleground for your budget.
Yeah, and it's not just early stage startups either. I mean, look at Vanta. They recently reported crossing $300 million in annual recurring revenue.
Oh, wow.
300 million ARR. They took a leader position in the Forrester Wave. That isn't a niche tool anymore.
No, not at all.
That is a massive, entrenched enterprise scale. And they achieved it by automating evidence collection in a way that used to require, like, literal armies of auditors.
Yeah.
But the wave isn't stopping there. By July, we saw this reaching the pre-seed stages in Munich with a company called Auxilius.
Oh, right. Them.
Yeah, they're raising money on this wild, futuristic premise that compliance controls should literally compile into executable code. So the code itself is the compliance evidence. Plus, behind all these headline names, there is this massive long tail of seed rounds, Y Combinator batches, open source challengers, and every single one of them claims to be building what this industry has spent 25 years calling an enterprise GRC platform.
What's fascinating here is the narrative that gets spun around this.
Yeah.
Because the usual explanation you hear for all this frenetic activity is simply that venture capital found a hot category. You hear that, cyber risk is up, regulatory fines are in the news, so naturally the money follows the headline.
Right, the standard VC playbook.
Exactly. But if you actually look at the engineering, the money is telling a much more specific, almost structural story. Venture capital is flooding in because GRC software turned out to be incredibly easy to build.
Wait, I have to stop you there.
Yep.
Easy to build.
Mhm.
For decades, these legacy enterprise vendors have pitched their platforms as these incredibly complex, impenetrable fortresses of engineering.
Oh, I know.
They sell it as if they've mapped the human genome. You're saying it's easy.
Yes, I am. And that fortress, it was an illusion. What the industry sold as massive platform value for the last 25 years, it was never actually the hard part of the technology stack.
Wow.
Venture capital didn't just stumble into a hot space. They realized the barriers to entry in that space had entirely collapsed. The moat just dried up.
Yeah.
So, to understand why you as a software buyer need to completely rethink how you evaluate these vendors tomorrow morning, We have to deconstruct the technology stack of a GRC platform from the absolute bottom up.
Right.
We need to look at where the data actually lives.
So if we accept that the data storage might just be a commodity, that immediately raises a massive red flag.
Huge.
Like, why are companies still cutting those million-dollar checks? We need to look at the mechanisms. In the Wheelhouse article, we break this down into a stack. And the very bottom of that stack, the absolute foundation, is the data model. So let's start there.
Right. Think about the classic sales pitch you get from a legacy GRC vendor.
Sure.
They come into your boardroom and talk about the celebrated complexity of GRC data. They put up this massive slide showing how difficult it is to map a single security control, say, a password policy, to 20 different regulatory obligations across 5 different international jurisdictions and multiple internal business units. It looks like a giant spider web.
Yeah.
It sounds overwhelmingly complex to a human being.
Oh, absolutely. I mean, if I'm a compliance manager trying to track that spider web on a massive Excel spreadsheet, it's a total nightmare.
Yeah.
One update to a European privacy law and my entire spreadsheet just breaks.
Right, for a human, it's a nightmare. But in computer science, this is just a standard many-to-many relationship. And here is the brutal reality check for anyone paying a premium for this. Relational databases solved this specific class of problem in the 1980s.
The 1980s.
Literally the 1980s. IBM and Oracle solved this before most current startup founders were even born.
That is wild.
Right. When you need to map one control to multiple obligations, a database uses a mechanism called a junction table. Think of a junction table like a digital traffic cop.
Okay.
Instead of copying a massive file 20 times for 20 different regulations and bogging down the system, the table just holds 2 tiny ID numbers. It says control number 5 connects to regulation number 12. It takes microseconds to process. A junction table is a textbook exercise for a first-year computer science student. It was already a completely commoditized piece of technology long before the very first GRC platform ever shipped.
I love this point because it perfectly highlights the disconnect between software marketing and software engineering.
Yes.
It's like a restaurant charging Michelin star prices just because they successfully installed a working refrigerator.
That is a perfect way to put it.
Right, because the storage isn't the chef. You don't pay a premium for the fact that the ingredients are kept cold. You pay for what the chef actually does with them.
Exactly.
But for years, these vendors were essentially charging enterprise premiums for the refrigerator.
That is exactly what happened. The data model is just the refrigerator. Now, sitting directly above that data model in the stack is what we call the hardening layer.
Okay.
And to be fair to the legacy incumbents, this layer actually did hold out longer as a genuine barrier to entry.
Okay, so take us back a bit. If the database was easy, what made this hardening layer so difficult historically?
Let's go back to roughly 2010. If you wanted to build enterprise software back then, you couldn't just have a working database traffic cop. You had to build enterprise-grade identity management.
Right.
You had to engineer granular role-based access permissions, meaning making sure the intern can't see the CFO's risk reports.
Yeah, that's important.
Very. You needed robust encryption at rest and in transit. You had to build immutable audit logging so no one could, delete their tracks, and you needed complex data retention policies.
Wow.
10 or 15 years ago, engineering all of that securely took a vendor years of highly specialized development time. That hardening layer was the true moat that separated real enterprise software from a basic consumer app.
It was the literal wall around the castle.
Yeah.
If you couldn't afford to build the wall, you couldn't sell to a Fortune 500 company.
Precisely. But look at the 2026 reality. Cloud computing services, AWS, Azure, Google Cloud, they have completely ended that dynamic. What used to be a multi-year, highly specialized engineering build is now essentially a configuration exercise.
Wait, you're saying a startup doesn't have to build identity management anymore? They just, plug it in?
That is exactly what I'm saying. You don't build it. You configure your application against managed identity providers like Okta or Azure AD. You deploy your code on infrastructure that is already compliance certified by the cloud provider.
Wow.
You toggle encryption on via the AWS dashboard. The massive deep moat that legacy vendors spent years digging has been entirely paved over. It's been turned into a public toll road that any startup with a credit card can just drive right across.
Okay, if I'm a buyer listening to this, I'm looking at my budget and I have to push back a little. If these two bottom layers, the database traffic cop and the security wall, are essentially decades-old commodities or easily configured cloud services, why in the world are buyers still getting quotes for massive premium prices for them?
Because inertia is a very powerful force in enterprise procurement.
Yeah, fair.
Buyers have been conditioned for 20 years to believe that securely storing and linking risk data is inherently expensive. But this is your first major practical takeaway for evaluating a vendor today. You must actively look for red flags where vendors are overcharging for basic data management.
Okay.
Together, the data model and the hardening layer form what we call the system of record. It is simply the trusted store of risks, controls, obligations, and their connections.
It's a filing cabinet. Secure, organized, but just a filing cabinet.
Exactly. The system of record is nothing more than a highly secure filing cabinet. It went to commodity years ago. The problem is the market kept pricing it as if it hadn't. When you are looking at a vendor's pricing sheet tomorrow, you need to ask yourself, am I paying a premium for this vendor's unique intelligence, or am I paying 2015 prices for 2026 commodities?
That's a great question to ask.
Right. If a vendor's primary value proposition in their demo is that they securely store and link your data, they are selling you a very expensive filing cabinet.
Are you ready to see risk management in action? At Wheelhouse Advisors, we've launched a new YouTube channel dedicated to integrated risk management. You'll find quick explainers, insights from our IRM Navigator research reports, highlights from the Risk Journal, and conversations from the Risk Wheelhouse podcast. We're covering the topics that matter most to executives and risk leaders, from AI governance and cyber insurance to operational resilience and regulatory change. Every video is designed to help you anticipate risks, adapt with confidence, and build resilience in a digital-first world. In our first video, we explain how ISO 42001, the EU AI Act, and the NIST AI Risk Management Framework can work together as a unified playbook for AI risk. Subscribe today at youtube.com/@wheelhouseadv and get the latest insights delivered directly to you. That's youtube.com/@wheelhouseadv. Subscribe now and stay ahead of the risks that matter most.
And no one should be paying $1 million for a filing cabinet in 2026.
No.
I mean, this is such a critical shift in perspective. So if we accept that the storage is effectively a free commodity, that immediately raises the next question. What about the interface? What about the people putting the files into the cabinet?
Yes.
Because if we move up the stack, we transition from the system of record to what we call the system of engagement.
And this is the bracket where the most violent disruption of 2026 is actually happening right now.
Okay.
The bottom layer of the system of engagement is the application layer. This is the user interface. It's the forms, the automated workflows, the colorful dashboards. It is quite literally nearly everything a user ever actually sees and interacts with on a daily basis.
So what has happened to this layer? Because building a good, intuitive dashboard used to require armies of front-end developers.
Well, AI-assisted software development has made building this layer close to free. We are at a point where a risk professional, not a software engineer, but a practitioner who understands the business logic, can verbally describe a complex risk assessment process to an AI development tool and have a working, hardened application in a matter of days.
Okay, I have to challenge that. You're telling me a risk practitioner with zero coding experience can build an enterprise-grade workflow in a matter of days just by talking to an AI?
Yep.
That sounds like pure marketing hype. I mean, what about edge cases? What about routing logic?
I know, it sounds like hype until you see the mechanism in action. You aren't writing code, you are prompting a large language model that has ingested millions of lines of open source React and Python code.
Oh, okay.
You tell the AI, build me an intake form that asks for vendor name and data type. If the data type is PII, route an approval to the privacy team. If not, route it to IT.
Wow.
The AI generates the back-end logic, the front-end form, and the database connections instantly. You iterate on it for a few days to catch edge cases, and you deploy it.
That is staggering.
Which reveals a deeply uncomfortable truth for the established incumbents in the GRC market.
Yeah.
Think about it logically. If the visible product, the interface, the routing, the dashboards, if all of that can be convincingly rebuilt by a practitioner in a single week using AI tools, then the legacy platform was never really a complex technological marvel.
Wow.
It was mostly just basic forms and workflow sitting over a database. It was a system of record wearing a very expensive customized interface, masquerading as a premium platform.
It's like finding out the Wizard of Oz is just a guy behind a curtain pulling levers.
Exactly.
And the levers aren't even that complicated to build. But the system of engagement isn't just the forms, right? There's another layer sitting right beside it in the engagement bracket. And this is where things get really fascinating from a labor perspective.
Yes, the semantic interpretation layer. This is the layer that is actively deflating as we speak. Historically, think about what a compliance professional actually does all day.
They read a lot.
They read a dense 300-page regulatory update from a European financial authority. They interpret what those dense legal requirements actually mean in plain English.
Right.
They map those requirements back to an internal control library. They reconcile overlapping frameworks, figuring out how one specific IT control satisfies a GDPR privacy requirement and an ISO security standard simultaneously.
That sounds like incredibly tedious, highly specialized human work.
It is. And crucially, it was never really software. It was consulting labor, mostly billed by the hour.
Oh.
Enterprise companies paid armies of consultants from the big firms to sit in conference rooms and do this mapping and interpretation manually. But here is the technological reality of 2026. This kind of semantic interpretation, reading unstructured text, identifying the underlying intent, and mapping it to a structured taxonomy. This is exactly the mechanism that large language models were built for. They are ultimate pattern matching engines.
Here's where it gets really interesting, because we aren't just theorizing about this shift. We have hard data backing up this massive structural change.
Mm-hmm.
If we look at the 2026 IRM Navigator Viewpoint Report, the numbers are wild. This phenomenon is called the human work compression pattern, and the report quantifies this by showing that the services share of total market value, meaning the actual money spent on human consultants, is forecast to fall from 15.9% in 2026 down to 12.0% by 2033.
Let that sink in.
Hold on, I want to do the mental math on this.
Yeah.
If we are talking about a total market currently sitting at almost $70 billion, 3.9% of that market is nearly $3 billion.
Yep.
We are talking about billions of dollars evaporating from consulting timesheets in just a few years.
Yeah.
Where does that money actually go?
It goes into the software.
Okay.
The report notes that because compliance is where the vast majority of human artifact production actually concentrates, all those reports, mappings, and evidence gathering, GRC is absorbing the largest share of this redistributed consulting value.
Wow.
The labor is literally being compressed into the code. So going back to our metaphor, if the database and security layers are the filing cabinet, the system of engagement is the clerk.
Right, Ipler.
The clerk is the one reading the incoming documents, figuring out where they go, filling out the intake forms, and fetching the files when asked. The filing cabinet became cheap decades ago, but because of large language models, the clerk is becoming nearly free this year.
Okay, this brings us to a massive inflection point. If you are a buyer and you now realize the filing cabinet is a cheap commodity and the clerk is now effectively a free commodity, where does the actual value lie? What are you actually supposed to be paying for? This moves us to the very top of the technology stack.
This brings us to the system of action. And this is what every procurement team needs to obsess over.
Okay.
The system of action does not merely file a risk into a database. It doesn't just route a task to a manager and wait for a human to hit approve. A true system of action has the intelligence to see across performance metrics, cyber resilience, assurance reporting, and regulatory compliance simultaneously.
Wow.
It doesn't operate on a static representation of a risk. It operates on the risk itself, with the full, nuanced institutional context required to make a real business decision.
Can you give us a concrete mechanism for that? Like, what does that actually look like in practice?
Yeah, it's the difference between software that sends an alert saying, hey, your European server farm is out of compliance.
All right.
And software that says, your European server farm is out of compliance. I have verified this violates our SOC2 commitments. I see the secondary compensating control also failed. I have analyzed the business impact of downtime, and I am dynamically adjusting the AWS firewall rules right now to isolate the server, while simultaneously opening a priority ticket with network ops and generating an incident report for the privacy team.
It's actually taking the wheel.
Exactly. And the reason this specific layer resisted commoditization for so long is simple. Until the current generation of agentic AI, it simply could not be built.
Yeah.
No 30-year-old database textbook solves the problem of cross-domain contextual decision-making. So, if the system of record is the filing cabinet and the system of engagement is the clerk, then the system of action is the officer.
The officer.
The officer is the one with the actual authority to act on what the files say.
But wait, how does a buyer actually tell the difference in a demo?
Yeah.
Because right now, every single vendor on the market is slapping AI on their website in massive font.
Oh, they definitely are.
How do you tell the difference between a vendor who has genuinely built a true officer and a vendor who just dressed up a clerk in an officer's uniform?
That is the multi-million-dollar question right there. The difference lies in distinguishing between a basic chatbot and true intelligent agency. A lot of legacy vendors are terrified right now, so what do?
They slap a chatbot on it.
Exactly. They take their old forms, they bolt an LLM onto the front search bar, and they call it an AI platform. That is just a chatbot. It can help you search the filing cabinet faster, it can summarize a document, but it has no structural authority or context to act.
It's a clerk wearing an officer's hat reading off a script.
Precisely. True intelligent agency requires something called foundational program integrity.
Right.
To evaluate this, buyers need to ask vendors to demonstrate cross-domain context. Ask them in the demo, if a vulnerability is detected in our IT asset inventory, does the platform automatically understand the downstream legal impact on a specific regulatory obligation in Europe? And can it propose an accountable execution to mitigate it?
That's a great test.
Can the system explain why it is taking an action based on your specific corporate risk appetite? If the system is just suggesting text to help a human fill out a form field, it's a clerk.
Yeah.
If it's orchestrating a multi-step remediation across different enterprise systems, that is an officer.
That is incredibly practical advice for anyone doing a vendor bake-off. Look for accountable execution, not just text generation.
Exactly.
But understanding this technological shift, this migration from the bottom of the stack up to the officer, it completely rewrites the financial forecasts and the economics of the entire market.
It does. We are looking at a fundamental rewiring of how money flows in enterprise software.
Let's cite the exact numbers from the report because they present a really fascinating paradox.
Great.
According to the data, GRC is a $17.2 billion market in 2026. It is the second largest of four segments in the broader $69.7 billion integrated risk management market. And it is forecast to more than double, reaching $35.8 billion by 2033. But here's the massive anomaly. Despite doubling in size, GRC actually has the lowest growth rate of the four segments, with an 11.1% compound annual growth rate. So what does this all mean? How can a sector be exploding with venture capital, literally doubling in total size, yet technically be the slowest growing segment in the broader ecosystem?
If we connect this to the bigger picture, it makes perfect sense. The GRC segment isn't just expanding, it is violently modernizing.
Okay.
It is in the middle of a painful conversion from being a traditional system of record, which business leaders historically view purely as a necessary cost center, into the dynamic verification layer of modern agentic enterprise architectures.
And that sluggish growth rate reflects the friction of that conversion.
Yes. Growth and deflation are happening simultaneously. Deflation at the bottom, growth at the top. To understand the mechanics of this, we have to apply Clayton Christensen's law of conservation of attractive profits. It's a brilliant piece of economic theory. Christensen essentially proved that when one layer of a value chain becomes modular, standard, and good enough, it commoditizes. Prices drop. But when that happens, the attractive profits don't just disappear from the economy, they migrate.
Interesting.
They flow directly to the adjacent layer in the value chain that is not yet good enough.
Okay, let me make sure I'm applying that correctly to our stack.
Sure.
The filing cabinet and the clerk became good enough. They commoditized to near zero. So the venture capital and the enterprise procurement budgets are migrating up the stack to the officer.
Yep.
The system of action, because that is the layer that is still incredibly hard to build, still scarce, and therefore still commands a massive premium.
Exactly. A market where new entrants multiply rapidly, which is exactly what we are seeing with all these seed rounds and Y Combinator batches. That is fundamentally a market whose entry barriers have fallen.
Right.
That's introductory economics. But Christensen tells us exactly where the money goes next.
And the Wheelhouse forecast actually quantifies this migration in a really stark way.
It does.
The analyst had to make an unusual admission with this latest report regarding a massive $5 billion gap. Let's walk through the mechanics of that.
In the 2025 edition of the forecast, just 12 months ago, risk management consulting was projected to be the fastest growing segment of the entire market. It was expected to compound at almost 17%.
Okay.
But within a single year, the sheer acceleration of agentic AI, parsing regulations, and mapping controls made that entire trajectory completely untenable. The 2026 edition had to completely reverse it.
Meaning consulting doesn't even appear as a standalone segment anymore in the new forecast. It's just gone.
Correct. The projected $147 billion total market for 2032 was revised down to $141.6 billion. That roughly $5 billion gap. That is direct services displacement.
Wow.
That is the consulting labor, the semantic interpretation, the mapping, the reporting being entirely compressed out of existence by AI.
But the money leaving consulting isn't just vanishing from the risk ecosystem entirely. I mean, companies still have budgets.
No, it's not vanishing. The dollars leaving hourly human delivery are arriving as software capability.
Oh, I see.
This is exactly why TRM, Technology Risk Management, is now compounding at 13.9%, which is significantly higher than previously published. Migrating consulting spend converts directly into platform-embedded agentic capability.
Okay.
As a buyer, you aren't paying an external firm to map your controls once a year. You are paying a software platform to automatically maintain that mapping dynamically every single second of the day.
Which gives you, the buyer, incredibly clear direction on how to compare costs. When you're looking at a legacy vendor, you're paying inflated premium software prices for a system of record. You are overpaying for the filing cabinet.
Yeah.
But when you are evaluating a modern agentic platform, your software costs might look high on paper, but you have to factor in the mechanism of what it does. That software has absorbed hundreds of thousands of dollars of expensive consulting labor. You are buying the officer, and the officer works 24/7 without billing by the hour.
That is exactly how procurement teams need to frame their ROI calculations. However, we have to issue a massive warning here.
Let's hear it.
While this new market architecture is full of promise, buying into the wrong vendor during a period of rapid commoditization carries immense structural risks.
Because with all these new entrants, with all this venture capital sloshing around a newly paved road, there are going to be spectacular failures.
Oh, absolutely.
The Wheelhouse article explicitly calls this out. We need to talk about the cautionary tale of Delve.
Delve is the perfect example of what happens when a market commoditizes so quickly that the underlying integrity gets lost in the hype. Delve was part of the highly celebrated AI native cohort.
Right.
They raised a $32 million Series A at roughly a $300 million valuation. On paper, they were the exact kind of modern disruptor we've been talking about. They had the beautiful AI interface, the quick deployment claims.
But the timeline of their collapse is just breathtaking. Walk us through what actually failed.
It was incredibly fast. By March, they were facing serious whistleblower allegations regarding their actual engineering practices. Remember when we talked about foundational program integrity?
Yeah.
Delve didn't have it. They hadn't built a robust, mathematically sound understanding of cross-domain risk relationships. Instead, they were just scraping raw data and using an LLM to hallucinate compliance reports that looked correct to a layman, but fell apart under the scrutiny of an actual audit.
So they built a really fast clerk that was just making things up to hit deadlines.
Exactly. By April, major named customers were actively departing. These enterprise clients realized they had to completely recertify their compliance postures elsewhere at massive expense because they could no longer trust the evidence the platform was generating.
Oh, that's brutal.
Shortly after, Delve was quietly removed from Y Combinator's public portfolio directory.
A $300 million valuation reduced to vaporware in a matter of weeks.
Yep.
So how does a buyer protect themselves from buying the next Delve? Like, how do you test for that integrity?
This goes back to a concept in the report called the IRM Navigator Curve. The fundamental lesson is that when foundational program integrity is missing, agentic compliance is structurally unstable.
All right.
When the commodity layers, the basic data models and interfaces are so cheap and easy to replicate, bad actors can build software that looks amazing in a controlled 30-minute demo.
Right.
Competition degrades into a race of speed, price, and empty marketing claims. Delve was fast and had great marketing, but when an actual stress test happened, the structural integrity of the system wasn't there.
So if you are that buyer and you're staring down a short list of vendors tomorrow morning, Let's synthesize all of this into a final mandate. What is the absolute bottom line?
The bottom line is that the practical question for procurement has permanently changed.
Yeah.
It is no longer about which vendor has the most feature-rich record and engagement tiers. Do not pay platform premiums for filing cabinets and clerks. Focus your entire vendor evaluation strictly on the system of action. You have to look the vendor in the eye and ask, are you just defending a commodity margin strategy with a visible expiration date? Or are you genuinely building integrated, accountable execution?
Test them.
Test their system with edge cases during the demo. Break their script. Ask it to make a cross-domain decision right in front of you. If it just points you to a static policy document, it's a clerk. Walk away.
It's all about finding the officer.
Exactly.
That is such a clarifying lens to view this chaotic market through. I want to thank you for listening to this Risk Wheelhouse deep dive. As a reminder, you can find the full 2026 IRM Navigator Viewpoint Report, along with far more insights on the modernization of risk tech at www.wheelhouseadvisors.com. We've covered a tremendous amount of ground today, from the mechanics of 1980s database traffic cops to the collapse of human consulting labor. But before we wrap up,
This raises an important question, something we really need to sit with as this technology advances. If the filing cabinet became a free commodity decades ago, and the clerk became a free commodity this year, what happens in the near future when the officer, the system of action, inevitably becomes good enough and commoditizes too?
oh, wow.
If the software is actively making the institutional cross-domain business decisions based on executable code, where does the human liability sit when the machine acts on a risk and gets it wrong?
That is a scary thought.
We've successfully compressed the human work. Now we have to figure out how to compress the human accountability.
It's one thing when a human clerk misfiles a document. It's a completely different legal nightmare when your AI officer decides on its own to shut down a European server farm because it misinterpreted a GDPR update.
Exactly.
Who goes to jail? The software vendor or you? That is the structural reality we are all wading into next. Until next time, keep diving deep.
That wraps up another episode of the Risk Wheelhouse. Thank you for spending time with us at Wheelhouse Advisors today. We hope you found the conversation insightful and actionable for your organization's risk strategies. Don't forget to subscribe on your favorite podcast platform, whether it's Apple Podcasts, Spotify, or Amazon Music. If you're looking for more in-depth analysis and thought leadership on risk technology, be sure to visit the Risk Tech Journal at therisktechjournal.com. It's your go-to source for comprehensive articles, expert interviews, and the latest trends shaping the industry. Subscribe today to stay informed. For any inquiries or feedback, please contact us directly at info@wheelhouseadvisors.com, or feel free to connect with us on LinkedIn and x.com and share your thoughts or suggestions for future topics. Visit wheelhouseadvisors.com for more information and resources. Thanks again for joining us. Until next time, navigate wisely.